Even though the CEO of Geneva, Aaron, is down in Costa Rica with his beautiful wife, he's going to be back soon and very relaxed and very focused on his business. So if you're a loan officer and you want to talk with a focused and relaxed owner of a company who's great, Geneva might be the ones to talk to. Click this banner right over there. Okay, so one thing that we're constantly talking about is mortgage credit availability. And what this is the type of loans and the terms of the loans that are available for consumer consumption. So when Wells Fargo comes out with the latest 97% loan because they hate HUD, or when lenders start writing loans for sub 640 credit scores, credit availability increases because consumers have more options. Get it?
The problem is, according to the Mortgage Bankers Association, credit availability has gone down for the last 3 months, which means fewer options and tighter restrictions on an already unbelievably tight market.
Now, we've said time and time again that lenders are not loosening credit because the risk far outweighs the reward. Meaning the more lenders put themselves out with lower standard loans and products, the higher the risk for buybacks and fines. So, should lenders take the risk, loosen standards, and increase mortgage availability, or not? Let's think about this.
Well, according to the NMRI, the National Mortgage Risk Index, which measures the housing market risk to determine the ability of the housing market's ability to withstand stresses similar to the 2007 financial crisis, has recently said our composite is the highest it's been since the crash.
The highest risk we've seen since this whole thing blew up. So the highest risk for defaults on loans at 24.04% is FHA. No wonder nobody wants to write these loans. And Fannie Mae and Freddie Mac come in at a combined 6.37%.
So does this suggest our current unrest might spur another housing recession? Well, this risk index has only been around for a couple of years and frankly, untested. So forecasting a housing collapse based on this index is probably a little premature.
Doesn't make it wrong, it just makes you really second guess it, right? But we also have to think of the lack of inventory and baby boomers who control 2/3 of the equity seemingly not ready to move up or down and cash in or out on some of their equity, and mocha drinking bearded hipsters not wanting to buy homes, content living in mom's converted garage. It makes you think. Perhaps what the housing industry might need today right now to thwart another downturn is a booster shot of credit availability. Have lenders lower their guards, soften their ramparts, and loosen standards. Because if they don't, it may be possible for the housing market to stall.
And if those fellas who put together the National Mortgage Risk Index are right, we all might be sledding down a hill once again. And here's the thing.
And this is the crux of the story. This is where it unveils itself. The money shot, you might say. According to the Mortgage Bankers Association survey that we were just speaking about, 90% of lenders, stop and think about that for a second here. 90%, virtually all lenders lending on mortgages in the entire country have said they have no plans to relax their standards anytime soon. They're content right now with pretty damn fantastic margins and little exposure to risk. We're in a market where the reward far outweighs the risk. Let's think about that.
So this is twofold. One, the reward or margins on the loans being written right now are pretty doggone high. So say if a lender had lower margins, they might have to loosen credit to close more loans to keep their profits up. And that is not happening. So good margins keep credit availability down.
And secondly, the risk is just simply too high. Meaning it's perceived right now by lenders that writing the wrong loan comes with too much risk. Just ask Quicken, Wells, Guild, M&T, and really so many more. We could talk all day about this. So if the perceived risk was lower, then lenders would be more inclined to loosen their credit and increase their profits. But this, my friends, is also not happening.
So really, it's a perfect storm of sorts. The risk is too high, the reward is pretty good, and as a result, 90%, virtually all lenders surveyed said, we're not loosening up anything.
And the point Frank just made, the 90%, it will not change to give you more change until one of these two variables just outlined does change. There's a lot of weird things going on in the world right now.
Yeah,
there's
there
a
is.
lot of strange stuff in Europe. There's the whole Brexit thing.
Yeah.
There seems to be a lot of unrest here. I'm not saying that there's something of a mortgage market or a housing downturn coming in front of us, but boy, sure would be nice to see a stronger housing market, wouldn't it?
It'd be nice if everything was just mellow and easy and happy.
People getting along.
You know, people just getting along, markets just getting along.
Hey.
That would be nice.
If you want to be happier, quit going on Facebook.
It's true.
It's miserable right now.
It is
It is
miserable.
miserable.
You guys have a great weekend. We'll catch you here on Monday on the National Real Estate Post. Leave us your comments down below. Forward, share, and subscribe for in the upper right-hand corner. And adios.
Hey, if anybody sends me anything on Facebook, just make it kittens. All I want's kittens. No Donald Trump, no Hillary Clinton,
Even that gets annoying.
no guns.
Even kittens get annoying.
No, I want kittens and puppies.